Avneet, what kind of returns can I expect from equities over the long run?
Anywhere between 10 and 12%.
See, my CA shared this investment opportunity with me. It says these bonds are going to give me not 10%, not 11%, not 12%, not even 12.5%, 13% returns. Is this some kind of scam?
So these look like securitized debt instruments. No, they are not a scam. In fact, today there are many such alternative investment products available in the market that can give you returns anywhere between 9 and 13%. But obviously, higher the returns, higher the risk.
What kind of risks are we talking about?
Well, let's discuss that in detail. Today we have many products that offer 10 to 12% returns, some even higher. And most of them belong to this category called alternative investments. One of the first few products in this space was P2P lending. Then came online platforms offering secured bonds. Now you have many more options such as assets leasing, securitized instruments, invoice discounting, and fractional ownership of real estate. But as the investment options have increased, so has the confusion. Investors have a lot to choose from and they have many questions. Are these alternative investments safe? How to analyze them? Which platform to choose? And many more. So today we'll look at these investment options and understand their risks. Hello and welcome to ET Money's YouTube channel. In this video, we'll discuss products in the alternative investment space and how they work. We'll cover secured bonds, assets leasing, securitized debt instruments or SDIs, invoice discounting, P2P lending and fractional real estate. If you are interested in any specific product, you can jump directly to that section of the video. First, let me quickly explain the 5-step framework that we'll use to evaluate risk in these financial products. While financial products have different risks, we believe investors should first look at 5 critical risk factors. We'll examine each of these risks individually in the 5-step framework. In step 1, we'll look at the chances of you losing money. In step 2, we'll evaluate how easy it is to sell your investment. In the next steps, we'll examine whether there are regulations for the product, the company and intermediaries or distributors. And finally, we'll look at the product-specific risk. So let's evaluate the first alternative investment option based on this framework. These are the most common investment options on online platforms. Traditionally, you must have heard of corporate bonds, government bonds, and non-convertible debentures. These popular fixed income options offer around 6 to 8% interest. Many online platforms offer senior secured bonds that can give you double-digit returns. At the time of recording this video, we saw issues offering between 10 and 11.5% yields. Now to understand the concept, let's split the two words. Secured means that these bonds are backed by some kind of security or collateral. Usually these bonds are issued by NBFCs and the collateral is the loans that NBFC gives to its customers. So if an NBFC is into personal loans, the collateral will be the money it will receive from these personal loans. Now, senior means these investors have the highest priority among all bondholders if the company goes bankrupt. Let's now evaluate these covered bonds using our risk evaluation framework. Let's first look at the risk of losing capital. In theory, there's always the risk of losing capital in such bonds. The companies that issue the bonds give higher returns as their credit ratings are not the best ones. So you may not see companies with AAA or AA ratings. These are usually businesses with A or BBB ratings. But according to online bond platforms, the default rates for such ratings are less than 2%. So practically, there's always the risk of losing some capital. But because of the collateral in place, you may not lose all your money. But we have seen that even the best of lenders can fail. And when this happens, things get ugly and it takes a lot of time for any recovery. Let's now look at the liquidity risk. Now, most of these bonds are now listed on stock exchanges. However, you may not necessarily find a buyer when you want to sell. The secondary market for such bonds is still not developed. Therefore, even if you find a buyer, you might end up selling at a discount. For practical purposes, this investment should be buy and hold. Next, no regulatory oversight risk. Now there are two parties involved here. First is the issuer. In most cases, it's an NBFC, and all non-banking financial companies are regulated by the RBI. The second party is the intermediary or the platform from which you purchase these bonds. Now before 2023, none of the platforms offering bonds were regulated. But in November 2022, SEBI introduced regulations for online bond platform providers or OBPP. So as an investor, make sure that you are dealing with a platform registered with either Bombay Stock Exchange or National Stock Exchange. I have included a link to SEBI's website in the description. You can check the entities registered with the exchanges. Next, platform specific risk. Now, as discussed above, online bond platforms are distributors of products. The issuers are NBFCs and other corporates. Nonetheless, some platforms play a significant role in the bond issue. They work with the issuers to bring exclusive deals for their customers. There's a good chance that you may see an issue on Vint Wealth that's not available on Grip Invest and vice versa. As some deals are exclusive, the platforms do all the due diligence and checks before selling bonds on their website. However, if the bond issuer defaults, the platforms are not liable to pay you. So far, there have not been any defaults, and SEBI regulating them is comforting. But ensure that you are dealing with platforms registered with exchanges. Let's talk about the instrument-specific risk. As highlighted before, most of these bond issuers don't have the highest credit ratings. It means investing in them is riskier. The issuer offers security, but that does not guarantee 100% recovery in case of a default. To minimize the risk, opt for issues that have shorter tenors. Securitized debt instrument is not a new concept. What's new is that such products were unavailable for retail investors earlier. Thanks to online bond platforms, retail investors can now invest in them. Let's understand securitized debt instrument SDI using an example of an NBFC that gives out loans to small and medium businesses. The financier will transfer loans on its balance sheet to a trust and raise money against them. Now, this may sound similar to senior secured bonds, but it's not. In a senior secured bond, the NBFC makes the repayment, so the loan is in the NBFC's book. In an SDI, an NBFC does not make the repayment. The trust that holds the loans receives repayment from the MSME borrowers, and it passes this money to the investors. So in an SDI, your returns depend on repayment by the borrowers. For NBFC, these loans are transferred to a trust and they are no longer in the NBFC's books. Asset leasing also works on similar concept. So let's say a company gives out cars on lease and wants to raise money. The company will give investors the right to collect the money from the company that has taken the cars on lease. The vehicles, on the other hand, will be collateral. Now let's evaluate these instruments on our 5-step risk framework. Number 1, loss of principal. In senior secured bonds, you go by the issuer's rating, but in the case of SDIs and asset leasing, credit rating agencies assign a rating to the underlying instruments. So credit rating agencies look at the quality of the loans, cars or plants and machinery to rate them. In SDI, the platforms also take additional guarantees from the issue. These can be in the form of fixed deposits, property or personal guarantees by the promoters. So just like senior secured bonds, there's always the risk of losing some capital. But because of the collateral in place, you may not lose all your money. Number 2, liquidity risk. Now most of these are listed on stock exchanges like senior secured bonds. But you need to follow a buy and hold strategy as there's not enough liquidity on stock exchanges. Number 3, no regulatory oversight risk. RBI and SEBI both have securitization norms in place. Depending on the issuer, the online bond platforms follow either RBI's or SEBI's securitization rules. Now, while RBI regulates NBFCs, you'll need to check the regulator for companies involved in the leasing services. Number 4, platform-specific risk. SEBI now governs the online bond platforms, which lowers the platform-specific risk. Number 5, instrument-specific risk. While there's additional security in these instruments, it does not guarantee 100% recovery in case of default. Keep this in mind before investing in them. To understand invoice discounting, we would like to use a trader who buys and sells wheat as an example. Now he supplied wheat worth 50 lakh to ITC on credit. So ITC will process the payment 90 days after receiving the shipment. But after a few days, the trader received another order from Britannia. Now the trader needs money urgently to fulfill the new order, but he doesn't have enough money at hand. So he decides to get his bill discounted. He goes to a bank which offers him 49 lakh rupees in return for the 50 lakh bill. Once the 90-day period is complete, the bank will collect the payment for ITC. This way, the trader is able to meet his urgent cash requirement by discounting his receivables. The bank also made a 2% return in less than 3 months. This example shows how invoice discounting works. But when you go on online platforms, you don't deal with individual traders. Instead, the bank or NBFCs, which offer invoice discounting, pulls together many such invoices and offers them to investors. So the businesses and invoices are vetted by the financier. These two are sold on online bond platforms. The structure works just like SDI or asset leasing. The risks involved are also similar. I'm sure many of you would already be aware of peer-to-peer lending. It's a pretty straightforward concept. If you want to earn extra returns, you can lend money to individuals looking for loan. To facilitate this lending, there are peer-to-peer or P2P lending platforms. The platforms are responsible for evaluating the borrowers and managing repayments. There are different models that P2P platforms follow. Let me talk about two popular ones. You can look at the borrower's profile and choose whom you want to lend to. In this case, each loan will have a different interest rate and tenor, and you receive the money accordingly. Here there is a chance for you to earn higher returns. Even though you lend directly to borrowers, P2P platforms do not allow you to lend all your money to one borrower. Your money is spread among different borrowers to lower the risk. The second model works like a fixed deposit. You pay money to the platform for a tenor of your choice. The P2P platform offers different interest rates based on your investment. The returns are lower than those from lending to individual borrowers. Now, let's talk about the risks. Number 1, loss of capital. If you are directly lending to a borrower, there's always a possibility that the borrower will default and you will lose your money. So in this option, the chance of losing money is slightly higher. But if you give money to the platform, it's not as risky comparatively. However, there's always a chance that P2P platform goes bankrupt. So check the credit ratings of the platform before you invest and opt for shorter tenor deposits. Number 2, liquidity risk. If you are lending to borrowers directly, there's no liquidity. You have to wait until the loan is over. In case of defaults, the platform will initiate the recovery mechanism. So you'll have to wait to recover your money, and there's no guarantee that you'll get back the entire capital. But if you give the money to the company, there's an option to liquidate your investment. Number 3, no regulatory oversight risk. RBI regulates P2P platforms, so there's some comfort even though they are not risk-free. The next parameter in our framework is platform-specific risk. Now, even though regulated by the RBI, some platforms are better managed than others. So it's up to you to research and select the best option. Do check the NPS before you invest. The last parameter in our framework is instrument-specific risk. Besides what we have already discussed, there is no instrument-specific risk in P2P. Just ensure that you diversify across platforms and borrowers to spread the risk. Fractional real estate allows you to co-own a property. Now let's say there's an office space that costs 1 crore rupees, but you don't want to put all your money in one office. So 10 friends come together, each pays 10 lakh and buys the office space. You put it on rent and each receives 10% rent every month. That's essentially how fractional ownership of real estate works. Platforms that offer fractional ownership pool together money from investors and buy high-end office spaces. In addition to receiving the rent, which could be in the range of 6 to 8%, you also benefit from property appreciation, which could be 4 to 8%. So if you stay invested for the long term, there's a good chance to make upwards of 10%. The platform showcases different properties. You can choose the one you like. Once the funds are collected, a special purpose vehicle is formed. Each investor receives shares in this special purpose vehicle which owns the property. Now, let's evaluate this product using our framework. Number 1, loss of capital. Theoretically, it's possible to lose money if there's an economic slowdown. You may not find a tenant easily. Rents could be depressed and property value may be hit. But as India is a growing economy, such risk is not high. Let's move to the next parameter, liquidity risk. Now, investing in real estate has an inherent liquidity risk. The same is true in case of fractional ownership. If you invest through fractional ownership platforms, you first need to check the lock-in period. Once the lock-in period is through, you can sell your share in the property. For this, you can find a buyer or the platforms can help, but nothing is guaranteed here. Next, let's move to our next parameter, regulatory oversight risk. As of today, platforms offering fractional ownership of real estate are not regulated. However, in March 2024, SEBI brought in regulations for small and medium REITs or SM REITs that can benefit investors. A platform will now be able to list assets worth 50 crore rupees on stock exchanges, giving liquidity to investors. This will bring fractional ownership platforms under SEBI's regulations. For properties under construction, RERA regulations also apply. These require the developers to register their projects and provide detailed information about the property, construction timelines, and financials. Next, let's look at the platform-specific risks. Now, when it comes to investing through fractional ownership platforms, there's a risk of investing through fraudulent and poorly managed platforms. But SEBI's SM REIT regulations should change this. So if you haven't yet dipped your toes in fractional ownership of real estate, you can wait until these REITs start listing. Number 5, instrument-specific risks. Once you invest, you start receiving the lease rental, which is in the range of 6 to 8%. However, to make those extra returns on capital appreciation of the property, you must stay put for the long term until the asset is sold. Also, most decisions, disputes, and resolutions are settled by vote, so you have to accept the decision of the majority of the investors. With this, we move to the last part of the video. Here we just want to leave you with some tips and thoughts. The alternative investment space is new. If you wish to invest in any of the products, make sure you diversify. You spread the risk across products and platforms. Even though platforms take additional safety measures, it's still a risky investment. So don't invest your emergency fund in any of these instruments. These products are meant for seasoned investors who understand the risks. So these shouldn't be your first investment. Look at them after you have gained some experience as an investor. Start small, get comfortable, and then increase your investment amounts. Don't decide your investment solely on the basis of returns. With this, we have come to an end of this video. I hope that you found the content useful. If you did, I would request that you like the videos and share them with your friends and family. I'll see you next time. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.